On today's show, my guest and I discuss what might happen with real estate prices and the economy in the future, but we are just guessing. Do not make any investment decisions based on what two guys on a podcast say. This podcast is for informational purposes only and is not investment advice. Do your own research and make your own decisions. Got it? That should keep the lawyers happy. Let's get started. Will houses ever be affordable? What's going on? Ben Rabidoux is back. Fasten your seatbelts. It all starts right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ben Rabidoux runs North Cove Advisors, and this year he started Edge Realty Analytics Limited, where he publishes a detailed monthly newsletter, the Edge Report, plus a bunch of other stuff. It specializes in information you will not hear anywhere else. It costs money to subscribe, but today Ben's going to share some of those insights that he shares with his paying subscribers. So Ben, welcome back. This is your sixth appearance here on this show. The first one, number 379, the first one was number 95 in June of 2016. You remember that? That was like 4 lifetimes ago.
Way back. Yeah.
And the title of that show was What Happens to Debt When House Prices Fall? Those were good times when we could talk about house prices falling. And in fact, they did fall. It was, I think, May of 2017 that we hit the peak, and then they came down. And of course, they blasted off since then. It's totally crazy since then. Last time you were on was in January of this year, show 333. Good show. You gave a good summary of where we were at the start of the year. So there's really only one question I've got for you. And that question is, what's going on? What's happening? And you can start wherever you want. We can talk about housing, interest rates, inflation, wages. Sure. Where is the logical jumping off point? Is it employment? Does that feed into everything else? Is it inflation, interest rates? What do you think?
Well, let's do a 10,000 foot overview of what's happening in the housing market, and then we can kind of dive in from there. Because I think that's probably what a lot of your listeners would tune in to hear about, I think, when they see me on a podcast. So, look, I think what's happening right now with housing is we're seeing a continuation of some of the trends that we discussed back in January. And the most important trend that I'm seeing right now is that inventory levels across the country continue to plunge. And when I say they continue to plunge, like we've got entire provinces where inventory levels are down 40% compared to last year at this time, and they're down 70% compared to 5 years ago. So that's just an incredible steep decline. And when we frame it in terms of what we call months of inventory, which is sort of an easy way to visualize supply and demand. So the idea of months of inventory is if there's 100 homes for sale and 20 of them sold last month, you'd say, well, there are 5 months of inventory. It takes 5 months of sales to clear that level of inventory. And so a normal balanced market is kind of in the 6 range. It kind of varies by region. Some regions are sort of used to having months of inventory in the 3 to 4 range, some more kind of 6 to 7. But on average, we say kind of 5, 6 is a balanced market. Across the country right now, we're less than 2. And in Ontario, it's a record low at 0.8. So there's less than 1 month of inventory on the market, which is just an absurd number. And so, we continue to see very strong sales demand. There's a lot of discussion around how much of that sales demand is coming from investors versus end users. And I think it's very clear that we've got a lot of investor participation in the market, which you might expect with rates so low and given, how strong pricing has been. It's not at all surprising that some of the latest research is suggesting that up to 1 in 4 homes being purchased are being purchased by people who already own another residence. And so these are either investors or they're people buying recreational properties. And so, very strong demand, extremely low levels of inventory. There's just nowhere for prices to go but to squeeze higher. And that's what we've seen. And so as of last month, we saw a record dollar increase in the value of the typical home in Canada. So what I mean by that is the typical home in Canada increased by almost $140,000 compared to last year at this time. And in dollar terms, that's the highest we've ever seen, right? And so, I wish I could say that there's something on the horizon that would sort of upend that dynamic, but at this point, I don't see it. There's still some question around, why new listings have been so low, because that's what we've all been waiting for. When the pandemic hit, it sort of made sense that everybody went, well, I don't really want strangers walking through my house when I'm trying to sell it, so maybe I'll just sit sit pat and I'll just, I'll sell it later. And so we kept anticipating this increase in new listings once things started to ease up, and it's just never come. And so that's one of the big mysteries in all of this is like, well, where are all those new listings? Now, I want to be clear, we were already at extremely low levels of inventory before the pandemic hit. So even if we went back to kind of where we were before the pandemic, that's still a very low level of inventory across the country. So, to put some real context on this and to help people visualize it, like I've got this great chart that shows, if you plot the months of inventory on one axis, and then you can plot the monthly change in the seasonally adjusted house price index. And so the question is, well, at what point do prices start to fall nationally? And they never fall until you get to at least 5 months of inventory, and usually it's closer to 6 or 7. But if you use 5 as just kind of a base level, okay, we got to get to at least 5 months of inventory before prices flatline. Well, you're at less than 2 right now. So that means you need supply to more than double, or you need sales to fall by more than half, or some combination of both. Like I use the example of like, you could double you could double inventory and you could cut sales by 30%. And that would only get you back to a balanced market. So like we just have to have some perspective on how far we are currently away from that balanced market, that this is just not gonna, unfortunately, it's just like, this is a slow moving ship. Even if the inventory started to build tomorrow, we're probably not talking about any serious price pressure until maybe the second half of next year if things sort of stabilize. But that's where we're at. It's just an incredibly tight market that the path of least resistance for prices is still up to the upside. And you're probably going to see strong price appreciation and well into next year based on how it's looking currently.
So if I want to buy a house, I'm screwed, is what you're saying. Why? So why is this? Okay, I understand what you're saying. I understand about inventory. There's not that much of it, so that makes prices go up. That's basic supply and demand. Why? How did we get into this mess?
Yeah, there's a lot to discuss there. I mean, you can take that a bunch of different ways. I think, first of all, we'd have to start by acknowledging that when we look at the level of completions, especially for single family properties, right? So the number of new homes being built in that single family segment, it's very low historically when you compare it to the size of the population, right? So, and even if you look at, housing starts, they were very strong through the first half of the year. You look at units under construction, it's at a record high. So all of these things would seem to point to, well, look, we've got a lot of supply out there that's coming to market at some point. But the reality is, if you sort of parse that into the various components, right, and you look at condos versus rentals versus single family, you find that it's the condos and the rentals that are going crazy, and we're just still not building a lot of single family. So, when the pandemic hit, there was all of a sudden a lot of demand for single family. Everybody wanted more space. We talked about this back in January. And it became the segment that people wanted the most. And it was what we hadn't built enough of. And earlier this year, we did see a pretty big uptick in housing starts in the single family segment, but they've pulled back since. So we're back to quite low levels. So we're just not building enough, first of all, is one issue. And I know there's a lot of discussion around, well, if we had less investor participation, then would that matter? Like maybe, but I know there's people that want to make this into just entirely a demand side story. It's just not. I'm telling you, you look at these charts of what's happening with single family housing construction, you can't get away from it. It's very clear that we're not building enough, especially given the demand there. So that's one element. And the second
just on that point then. So again,
yep.
Why are we not building enough? You said that house prices went up by like $100,000 in the last year. So if I'm a house builder, I should be going nuts building houses because there's all this.
For a little while.
Yeah,
they were. Okay, so there's a lot of. Again, that's not an easy question. There's all sorts of issues around the zoning and getting the permitting to build. I mean, that's one thing. So there is very much this element. I've talked about this before, but the frustrating thing in Canada is that we've got very lofty immigration targets, very strong population growth targets, which are a good thing long term. But those are set at the federal level. But then the ability to deliver the houses that we need for that increasing population is set at the municipal level. And there you've got people who, are elected to municipal councils, and they have to listen to their next door neighbor being like, look, I don't want this new development going in behind us. It's going to do this to my property values. And there's all sorts of what they call in the industry NIMBYism. No one wants, it's like not in my backyard. And so, the population targets are set at the federal level. The ability to deliver the housing is set at the municipal level. There's a mismatch there. And so you talk to any developer and they'll tell you it's pulling teeth trying to get stuff built. So I think that's an issue. I think the immigration issue is a whole separate issue, because I do think that it would be smart, given the housing crisis that we're seeing, to at least open the discussion around whether our current immigration targets are the smartest way to go forward, right? In the sense of like, not just the numbers, but does it make sense to try to incentivize people to go to areas that are less dense, let's say, where you can deliver some of those housing, that housing be a little easier. So that's a whole other issue. Those are two issues that within that. But then the third is that I do think there's an element of, as you said, like you were saying, well, if you were a developer, wouldn't you build and try to get that money? I actually think to some extent it's potentially the opposite, right? Where you're making so much money by banking the land right now, right? And I'm not saying this is happening on a large scale, because it's expensive to do it. You need very deep pockets. There's only a handful of developers or families that could do this. But why would anybody develop any land right now when it's going up as much as it is? Why not wait? If it's going to be worth more next year, why would you develop it today? So those are just some of the dynamics that play into it.
Yeah, and what you just said about land applies to every kind of asset. So if I think, I don't know, whatever the thing is going to be worth more next year, then I'm not going to sell it this year. I might as well hold it. If I think that stock I own is going to be worth more next year, then I guess I better hold it till next year and sell it then. So with land prices and real estate prices continuing to go up, up, and up, I get it. I guess if I'm a developer and I can make 20% by doing nothing, might as well do that then. So you mentioned immigration, and immigration collapsed during the pandemic because the borders were closed, but I assume it has bounced back now.
It has. It's interesting though. So you've got sort of the officially reported immigration numbers, but then you also have the total population numbers, and they've sort of diverged in the sense that what we get reported is permanent resident admissions, right? Which is generally kind of the umbrella under which immigration falls. When we think of immigration, people coming here permanently. And so normally as permanent resident admissions increase, you see an increase in total population that sort of corresponds to that. We're not really seeing that right now. So for context, like population growth is still less than a third of what it was just before the pandemic hit on a sort of a total basis when you look at all forms of population growth in the country. And yet the feds are on track to hit a record number of new immigrants coming into the country this year. They're going to hit their 401,000 target. And so how do you explain that? Well, part of it is that what we consider to be new immigrants coming here is actually we're fast tracking non-permanent residents who are already here, and we're fast tracking them for permanent residency. And so the non-permanent residents that are already here are already counted in the total population. So they're getting counted as new immigrants, but they're actually already here and they've been counted. So even though you see these record numbers of new immigrants, many of them are already here. And so it's not corresponding into the same level of total population growth that we would normally see. That's one thing. The other is just that with the borders still closed, or not totally closed, but just challenging, we're seeing that the non-permanent resident cohort, which is like your foreign workers, international students, it's just not back to what it was before the pandemic. And I think it's going to take years to get back there. Like, you got to remember, before the pandemic, we were almost 600,000 new residents coming to Canada, right, in a year. So that's between permanent residents, non-permanent residents, natural increase in the population. 600,000 people were being added to the population. We're still around 200,000 right now. So we've got a long ways to go. I don't think we're going to get back to that peak level for quite a few years, is my intuition.
And yet, even with this drop from 600,000 to 200,000, real estate prices are still going way up. So if we go back to 600,000, then that's even more up, I would think. So the other factor in real estate is the interest rate. Yep. So the lower the interest rate, the more I can afford to buy, the more leverage I can get. What do you see happening interest rate wise in the future?
Well, I think that the current fear around inflation, I think we sort of have peak inflation paranoia right now. And so what I mean by that is when you look at what the bond market is pricing, or at least was pricing in until, we had all these variant concerns late last week. There were some pricing expectations of somewhere in the neighborhood of 6 rate hikes out to the end of 2023. You had some calls for as many as 8. I haven't checked, but I think we're already down to closer to 4 based on how quickly the market reacted to those variant concerns. I think those, to me, that's just, I don't see 8 rate hikes by 2023. And there's a number of reasons for that. One is just, or the main one is just that when we look at the sort of leverage that's embedded in the Canadian economy, and in particular at the household and the non-financial corporate sector level, it's extremely high relative to other countries. And so the ability, and so I did some work on this and looked at, okay, well, let's assume that you get those 6 rate hikes by the end of 2023. And you sort of make some assumptions around income growth. And well, what does that mean to debt service ratio, which is like the share of household income that goes to servicing debt? And people kind of forget that before the pandemic hit, we were sitting at 30-year highs in the debt service ratio, right? It was corresponding, as you know, Doug, to a sharp increase in insolvencies at that time, right? And the two are very closely related. As the overall debt burden rises, a lot more people come knocking on your door. And so the idea that we're going to have 6 rate hikes out to 2023, and we model out, well, what does that mean for the debt service ratio? I mean, it just blows out. It goes very quickly to record highs. And so that's a big issue. And then, you layer on top of that corporate leverage. It's just difficult to see the Bank of Canada pushing rate hikes that aggressively, given how quickly that'll slow the economy. So I certainly don't see it. And the other thing is, as we talked about off air here, is I think when you think about where inflation is going to be a year from now, I don't think it's going to be 6 or 8 or 10%. I think that there's certainly part of what we're seeing right now that it is transitory, that is going to work itself out. It wouldn't surprise me if we're still above the Bank of Canada's kind of 1 to 3% target band. But I mean, I'd be shocked if we're 6 or 8%. I wouldn't be shocked if we're 1 or 2%. I wouldn't be shocked. I'm thinking we'll probably be more in the 3 or 4% range. And I just don't know that warrants the sort of rate hikes, especially if we see inflation decelerating, if we see it going from 5 to 4.5 down to closer to 3. I give some cover for the Bank of Canada to kind of sit pat on that. So I would expect that we are going to see rate hikes next year. I would think a couple of rate hikes would be more in line with my expectations, and then we'll sort of, the Bank of Canada will probably be happy to kind of sit and wait and see how that all filters out. I think it's much more likely that to cool some of the excesses we're seeing in the economy, that they're going to lean more on regulators to do things like tighten up mortgage lending, right, as one example, rather than raising rates, which are a very blunt tool, right? So, so we'll see.
I agree with you. I mean, if interest rates go up, everybody's carrying so much debt, we're all toast. And it doesn't matter if you're talking about individuals, corporations, the federal government. I mean, everybody's got massive level of debt. So a little bit of an increase blows everything up. So you got to keep rates low forever. That's pretty much all you can do. And with respect to inflation, I got no clue either. I just play an economist on the podcast. I don't actually know anything. But if I had to guess, I would go way at the low end as opposed to way at the high end. So 1 or 2% inflation next year wouldn't, by the end of next year, by the end of 2022, wouldn't shock me at all, because you got, if debt levels, if interest rates do pick up a bit, and with all these supply chain issues, you can't buy anything anyway. So what's going to be driving prices higher? We live in a naturally deflationary world, technology, energy, all that kind of stuff. We eventually make it cheaper. So
yeah. I mean, I don't know. I would probably push back a little bit on that. Look, I think the view that, okay, if you're thinking about a range of possible outcomes, is it more likely that we're much higher, like your high single digits, or is it more likely that we're, closer to zero inflation, like 1 or 2%? I'd go with the latter, right? And I agree with you there. I mean, I do think that there's there's some reason to think that maybe we're moving into a period of time that is more inflationary, right? So it would, like I said, my base cases were sort of more in that 3% range, maybe a little higher. And I actually think that what we're seeing right now with the shift towards onshoring manufacturing, right? This push away from just-in-time inventory management, which was a disaster during the pandemic. All of that is going to increase cost, right? As we bring manufacturing back here from, let's say, China, which is going to happen. And the other thing is, and this is, I don't pretend to be an energy expert by any means, but I think there's a lot of reason to think that oil prices are actually going to stay considerably higher than people expect. There was so much of a push away from oil and away from investment and finding new oil. And the reality is we're just going to need it for so long. I think energy prices are going to be much higher than people expect for much longer than people expect. And I'm absolutely fading that view that we're like, oil is a dying industry. I mean, we're going to be using oil for both of our lifetimes. And I would fully expect that the oil demand is higher 10 years from now than it is currently. And that's not at all consensus, right? So, when you look at it through those lenses, I mean, that's some serious inflationary pressure, but I don't see it, in that 10, 20 hyperinflation type stuff.
But okay, when you come on in a year, we can see whether you were correct that we're in that sort of 3% plus range, or if I'm correct, which I've never been right on any of my predictions yet. So maybe this will be the first one where I think it's more in the 1 to 2 range. What do you think then about employment, wages, that sort of thing? Because according to my notes here, obviously there was a massive drop in employment when we were all locked in our houses. But in Canada, tell me if I'm right, we have actually bounced back to where we were or even higher than pre-pandemic, whereas the US has not yet bounced back. I assume it's because we're 85% vaccinated and they're 70% vaccinated or whatever. Is that what you're seeing? And do you see that trend continuing, or do you see something different?
Yeah, so it depends on which employment measure you look at. So the labor force survey, which is sort of the more popular employment indicator, we're back to above pre-pandemic levels of employment. The establishment survey, which is where they look at official payroll numbers from the government, is not quite back. But listen, it's still telling the same story, which is that we're trending very strongly in the right direction. And there's no question that employment is recovering. What I see, and I was writing about this before the pandemic hit, but I see an extreme shortage of labor. Okay, and so we can see this in some of the great surveys from the Canadian Federation of Independent Businesses, where they poll their members and they're like, well, what are some of the big constraints to expanding your business? And, it used to be that a relatively small percentage would say, there's a shortage of skilled and unskilled labor. And then it was creeping up and creeping up. Before the pandemic, it was at record highs. And then the pandemic hit, obviously that fell dramatically because, everybody was out of work. And so, if you needed workers, there were lots of them. But now we're back to record highs again. And so I see a record shortage of labor there. I see job vacancies that just hit 1 million in Canada. There are 1 million vacant jobs, right? So we know everybody's looking. If you are looking for workers, it's hard to find them, right? Well, then you look at the Bank of Canada's Business Outlook survey for the third quarter, and businesses that were responding to that survey said they have record hiring intentions. Okay, so you have already a shortage of labor, and you've got businesses planning on adding a lot more, right? And then, so when you sort of look at, okay, well, what's this likely to mean to wages? Or actually, before we get to wages, let's say this: where are those workers going to come from, right? So if we look at the working age labor force participation rate, so this is the share of the people who are aged 15 to 64 that are either employed or actively looking for work, right? It's as high as it's ever been. You have a record high in the labor force participation rate. So my question is, where are the workers going to come from, right? And how does that get resolved without it being very positive for labor, in the sense that wages are probably going to go up substantially? I really don't, at this point, don't see how we avoid that. And maybe that's the wrong way to phrase that. I don't mean how we avoid that. I mean, I see that as almost an inevitability, right? And so, we'll see that the labor market is coming back much stronger. It is interesting, though, that when you parse the data and you sort of break it out by wage bands, what we find is the higher income wage bands, especially called the top 40% of wage earners that earn more than $30 an hour or the salaried equivalent. I mean, employment's way above pre-pandemic levels. And during the pandemic, I mean, it only fell a little bit and it had recovered within a couple months. And it was really the lower wage bands that got hit the hardest, right? Which makes sense because we know it was sort of the services industries that got hammered the most. And so there's a lot happening in the labor market. But if you're if you're in the kind of the top half of the income spectrum, I mean, you're probably going to get, there's no shortage of jobs, lots of probably wage pressures building right across the salary spectrum. And I don't know how that doesn't continue for the next little while. It looks very good for the labor market for the time being. Which
also sounds inflationary. So,
yes, you are right.
Disputes my prediction there. Although your comments on the labor force participation rate, you were talking about a specific age band. If you look at the entire population, I mean, it's been coming down for 20 years, 30 years, something like that. Because you got the baby boomers starting to age. Well, a lot of them have aged out. So yep. you just got fewer of them. So, okay. So let's wrap this up here with you telling us what's going to happen in 2022 so we can all just, get our lives set here. So you've already said that real estate prices are likely trending higher, not lower, because there's really no other way it can possibly be. We don't have enough supply. We can't build supply really quickly because of zoning issues and a whole bunch of other things. So almost for sure, real estate prices are going up, not going down. There may be specific pockets where, okay, that city loses its one industry and it goes kaputs. But
yeah, and I want to put parameters around that prediction because I'm going to say that, and then 3 years from now when things soften, everyone's going, hey, you said. So I'm talking about like the next 6 months. I'm talking about like from here into the next spring selling season. It's really hard for me to envision a scenario where the market gets really upended. Now, what I would say, so 2022, you look out that way. I would say that the consumer still looks to be in very good shape. Savings are still high. The net worth is surging. Debt service ratios are still very low, although that's going to change if they start raising rates, but we'll cross that bridge when we get there. So to me, it still looks like the consumer's in good shape. But what I would say is we're starting to see signs that some of the crazy kind of oddities that we saw where you had consumer insolvencies at 30-year lows, right? During a pandemic and a massive recession. It's like, well, that makes no sense. Credit card delinquencies were at record lows, right? I mean, all these things you would not expect to see. And we're starting to see signs that that's actually starting to stabilize and probably moving in the other direction. So those were abnormally low, all of those indicators. And as we get into 2022, even though the consumer in general is in very good shape, I would expect that delinquencies, everything's going to start to move back towards a more normal level, but certainly not a crazy move from here.
That does not bode well for my business then. But you're exactly right. I mean, consumer insolvencies are at 20-year lows, 30-year lows, whatever it is. And until the pressure returns from collectors, then people aren't going to be motivated to be calling my office, even though they've got massive levels of debt. Interest rates, then, you've already given your thoughts on that. You said that, the consensus might be that the Bank of Canada is going to be cutting 6 or 8 times. That ain't happening.
Raising.
It. Yeah. Maybe it'll happen 1 or 2 or 3 times, and maybe we're talking 25 basis points each time, but it's not going to be anything massive. So is it true that more people are going variable as opposed to fixed on mortgages now?
Yeah, that's actually a really interesting dynamic. So right now what we're finding is that variable originations are exploding, and they're almost 55% of all originations right now. And just a couple of years ago, they were like 5%. And when you look at the originations overall, I mean, I just wrote this up, so I should know the exact numbers, but I think fixed rate originations compared to last year at this time were down like 30%, and variable rate originations were up like 80%, right? So you get this massive divergence in those trends. That does set up for an interesting dynamic. Now, I would also say that it makes sense why that's happening, because if you look at the spread between your fixed rates and your variable rates, it's very high right now. It's like 130 basis points, right? Which is quite high historically. And so you're sort of being incentivized to take these ultra low variable rates right now. Because you think, okay, well, if I lock in at 130 basis points, geez, that's 5 rate hikes priced in right there, right? Is the Bank of Canada going to hike rates 5 times? Like maybe, but I don't know, right? So it sort of makes sense why people are doing that. One thing people need to remember is even though we have variable interest rates, most of the time, not always, but most banks still have fixed payments. Okay, so there isn't a payment shock even as interest rates go up. What happens is, let's say your payment is $2,000 a month. If the overnight rate starts to go up and your variable mortgage rate rises, then a greater share of that $2,000 goes towards interest and less towards principal. And so what they're effectively doing is they're extending your amortization on you. And so there will eventually be a payment hit when you go to renew. It'll reset at that newer higher rate. If you want to keep on your original amortization schedule, now you've got to catch up. So you got to make kind of double payments. So it'll hurt at renewal, but there again, you're talking about 5 years down the road.
Yeah, right? If you've locked in for 5 years. So not locked in, I guess, but if
you've locked in most of the time your payments, right?
Right.
So I guess my point is just that, like, if we're talking about 2 or 3 rate hikes next year, I just don't really think that's going to be a disaster based on how strong the consumers look right now. It's going to slow things at the margin. It'll definitely take some steam out of the housing market. It's just not a disaster.
Yeah, and we're not giving financial advice here, so don't sue us. But you're right. The customer is speaking with their wallet. It's much more likely that people are going variable as opposed to fixed. And their math is pretty simple. Okay, well, it's 130 basis points less if I go variable, and that means 1.3% is what 130 basis points is. So if the government raises interest rates 3 times 25 basis points each, that's 0.75. I'm still way better off with variable. That's just the math people are doing.
Yeah, again, that's not advice for anybody.
No, we're not giving advice here.
We could be way off on this, but yeah, you understand where people are thinking when you're looking at a 130 basis point premium to lock it in, right? And it makes sense why people would be going, well, geez, that's pretty steep. Maybe I'll stick with variable for a while.
Might as well take it. So final question, since this is debt-free in 30, do you expect debt levels to increase next year? I mean, you talked about the savings rate, and I'll put a chart of it up. I mean, the savings rate spiked way up during the pandemic because, well, I can't go anywhere, can't spend anything, and I'm worried about the future, better tuck it away. That big spike has come down quite a bit. I mean, I think we've reversed half of it. And so I would expect that, well, we'll probably revert to the mean again, revert to the norm.
Yeah.
Do you expect debt levels to continue to increase, or are we going to continue deleveraging?
Yeah, I think they will. I mean, I think that, so we're already starting to see again, getting back to like, what are some of those early indicators that consumers are finally starting to, at the margins, feel a bit of a pinch. We're seeing credit card balances tick back up again. That was one of the weird things during the pandemic, is you said this like relentless decline in credit card balances. That's starting to tick back up again. So you're seeing consumer credit, like non-mortgage credit, is ticking up. Mortgage rate or mortgage growth has been kind of in the 9 to 10% range for most of the past year. It's probably going to continue to tick up. So yeah, I don't see any reason why it wouldn't. And the reality is the debt service ratio is still relatively low relative to kind of the past 10 years. So there's more room if rates stay where they are, or even if they go up 25 or 50 basis points, there's room there for consumers to take on more debt.
Yeah, and obviously you got to segregate between mortgage debt and credit card debt. Those are two completely different things. But you're right. The credit card balances that went down the most amongst the lowest income people, because I guess, hey, I'm getting CERB, I'm getting CRB, I don't have to pay for daycare, that sort of thing. I've actually got a couple extra bucks. They were the ones who were seeing that they were paying so much on credit cards, it made sense to leverage. Obviously that, can't go on forever. So, well, that's fantastic. We've covered a lot of ground here. Some of it will have been useful, some of it not, but there's a lot of moving parts. I think that's really the key to what you're saying. It's not as easy as, you just look at this one metric and that'll tell you what's going on. There's a whole bunch of stuff happening. There's supply issues, interest rates, inflation, wages, immigration, all these different pieces, which is why none of us really know what the future is. Any final words you would like to end with? You probably want to give us your Bitcoin prediction, I assume, Ben. Is that where you want to end?
Yeah. Yeah, I got zero insight into what's happening.
Good.
I'll take a hard pass there.
Good. Well, then we will leave it there because nobody has a clue on that as well. The best place to track you down, I guess people can follow you on Twitter. Is that the best thing, Ben Rabidoux?
Yep, they can do that if you're in the real estate space and you appreciate ongoing coverage and some of the reports. We check out edgeanalytics.ca. But otherwise, Twitter's an easy place to.
And I will put a link to that in the show notes as well, because Edge Analytics produces a kind of a complete report on here's what's going on once a month, and then you also do a deep dive on specific big cities real estate wise. Is that the same report?
Yeah, that's right. So that's exactly right. So 2 reports a month minimum, and then the odd kind of special report. But the first one being a deep dive of some of the granular trends in places like Toronto and Vancouver. I don't have the bandwidth to do every single little city, so we kind of focus on the real big ones. And then the big report is the Edge report, which comes out kind of third week every month, and it just goes through all of the important housing, credit, employment, population, all the important dynamics that affect real estate, and with the goal being that if you work in real estate or some sort of ancillary industry, that it just helps you to stay smart. And then we also do these infographics that people can share with their clients and prospects. They don't have to sort of attribute it back to me. And so we just take, 3 or 4 or 5 of the important key concepts that month, turn into neat infographics that are easy to share on social media. And then that's all available to subscribers.
Yeah, and pretty much the entire Canadian economy is real estate, so it probably is applicable to pretty much everybody who's out there.
Yeah, you're not wrong there.
Excellent. Ben, thank you very much for being here today. Much appreciated.
My pleasure, Doug. Good to see you again.
Excellent. Thank you very much. That is our show for today. If you're watching on YouTube, please hit the like button, subscribe, keep the algorithm going so more people can share this content. If you're listening on Spotify, Apple Podcasts, whatever, same thing, please subscribe. I will put links to everything we talked about in the show notes over on YouTube. Thanks for listening and watching. Until next week, I'm Doug Hoyes. That was Debt Free in 30.